everybody? It's Dr. Rick dropping in on you. Hope everybody's having an unbelievable Wednesday start to your day. I hope that this is going as planned. If not, if you're still breathing, you are still in the fight. We are about to get started. This is Wednesday, so this is Wealth Building Wednesday. Today, we're going to talk about the power and the importance of compound growth or investing in mechanisms that produce compound interest. We are about to get kicked off here. So I'm not going to be long. I got a client at the top of the hour, so this is going to move along rapidly. So before I get started, two things. Two offers are ending today. This is the last day to register for the webinar that I'm doing on Friday on unleashing the power of AI and how you can use that to either start a business, grow a business, monetize ideas, and so much more. That webinar is on Friday. The last day to register is today. It ends at 11:59 p.m. tonight. Also, I made a limited time offer on yesterday that also ends tonight at 11:59 p.m. For the person who's always said, I really would love to work with you, but when I get my money together, Doc, but I get that a lot. And I understand there's a reason why I charge what I charge. But here's an opportunity for the remainder of the day. If you've ever thought about working for me, this may be your opportunity. And this is for the ones who see the value. I don't have time to sell you the value. I'm here to talk about compound growth. But for those who see the value, for today only, you can purchase a bronze package and upgrade from a 12-week, 12-session bronze package to a 1-year, 52-session platinum package. That is a $12,000 value for you. That's the difference in the cost. So again, that opportunity is there. It ends tonight at 11:59 p.m. But if someone is interested, it's there. That's that. Look, I have interviewed in order to create the Legacy Wealth Past Generational Wealth course, which is I think the most robust and comprehensive course on wealth building online that you can go on and take as an online course. It's basically a college course on all of the mechanisms and principles of wealth building. If you can master 20% of this, it will change your life. It took me 10 years of chasing down people, interviewing people. So this isn't what Rick Wallace thinks in this course. This is what Rick Wallace uncovered by talking to the people who are the masters, the beasts, the kings of this thing, and getting their insight. And I'm going to read from two of them right now about compound growth. And then I'm going to go briefly over it. And I even pulled up a compound growth calculator to give you an idea of how powerful this is. Warren Buffett said, the goal of the non-professional should not be to pick winners. Neither he or his helpers can do that, but should rather is to rather to own a cross section of businesses that in aggregate are bound to do well. A low-cost S&P 500 index fund will achieve this goal. David Swenson, who is the manager of Yale's endowment fund, grew that endowment from $2 billion to $23.9 billion at last report. I'm pretty sure it's over that because these numbers are a couple of years old. He said, when you look at results on an after-fee, after-tax basis over reasonably long periods of time, there's almost no chance that you can end up beating the index fund. And what they're talking about beating is if you to a man and or woman, because I interviewed a couple of females, to a person, let's just say that the one thing that came across, well, there are a bunch of different things that were in sync. Everybody said the same thing. One of the things that was unanimous is that you can't predict the market. You can make educated decisions, but you can't predict the market. And this is what Warren Buffett says when he says the goal of the non-professional should not be to pick winners. Neither he or his helpers can do that. And we can see this evidenced in actively managed mutual funds, where we get 4%, a 4% win ratio, 96% of attempts to effectively beat the market by picking is ineffective. 96% fail. So only 4% at any given point are successful at picking the market, and it's never the same. So it's not like 4% just have the game on lock, and it's never the same 4%. So it's hard to pick on an actively managed mutual fund. However, the index fund is actually designed to mirror the market. So how the market moves, it doesn't have to beat the market because it's moving with the market. So you get the best performing companies come to in a conglomerate area. So there are a couple of things that happen with that. I'm going to talk about 5 benefits of indexing. But another thing that was unanimous is from the people that I interviewed is that you probably the most missed opportunity by people who are trying to invest is not investing in a compound growth mechanism, not taking advantage of compound growth. It's one of the things that I tell everybody you need to, and I'm going to show you why in a minute, but I'm going to give you 5 quick things. Diversification. Diversification is something that is taught. It is how you hedge. It's how you stabilize your investments. When you diversify, you don't have all of your eggs in one basket. Your asset allocation plan has you strategically placing your assets or investing in assets in diverse markets. So you want to diversify across assets, meaning you're not in just energy, you're not just in tech, you are diversifying. What investing in an index fund? An index fund is, say, for the S&P 500, it's the 500 top performing companies within the market. And so on the bottom end of that, number 1 through whatever, those pretty much stay the same. On the back end of that, number 4, whatever to whatever, they may change. They may fall off and other companies add it, and it's constantly being evaluated. So you're always dealing with the top 500 performing companies. Now, over the course of the years, it performs at the lowest 8.2 up to 10% and a little higher. And I'm going to get to that in a minute. I'm going to show you the math. I want you to see how powerful this thing is. But the diversification is an automatic. You talk about diversification, where when you invest in the S&P 500, now you are diversified. You're investing in 500 different companies. Lower cost index funds are passively managed, meaning that they aim to replicate the performance of specific indexes rather than trying to outperform them. And so there's low cost, potential for higher returns over time. Same reason. All right, ease of investing, because it's already set up for you. And, basically, I think for novice investors, this should be your first move. While you're learning how to read financials, while you're learning how to understand company history, while you're learning how to read markets and all of that to determine your long-term investments in individual entities and individual stock purchases, an index fund should be your first move. Number 1 is going to create a compound mechanism, something that everybody should be taking advantage of. Time efficiency, again, it's going to save you time. Now, what I want to do is I want to real quickly show you something. I pulled up an investment screen with an compound interest calculator. So it's going to ask you a couple of things: initial investment, monthly contribution, length of years, estimated interest rate, estimated variance and range. What that means is, what is the variance between the interest rates you put in and how much is going to fluctuate either up or down. and I put in 1% because it's pretty consistent with the S&P. So I put 1% on that, and I only put it at 8.5%. It has performed at 10% or better, but I put it at 8.5% just to be extremely conservative with these numbers. And here's the first entry. I entered $500 initial investment, $500 monthly contribution, and all of these numbers can be played with, and length of time of the investment, 20 years. And because of how compound interest works, um, because of how compound interest works, um, the earlier you get started, the better off you are. Say, for instance, a person who starts at 20 and only invests for 20 years and stops at 40, but still holds the investment. Well, at 60, they will have more money than someone who starts at 40 and invests for 20 years. You get it? It's compounded. So $500 initial investment, $500 monthly contribution, length of years 20, estimated interest rate 8.5%. Interest variance 1%, and in that 20 years, at that is $292,818. Now, that's not a nest egg you can retire on and live forever. No, but what you have to understand is the vast majority of people aren't doing this. So if you start at 20, let's say 25, you're working now, you're out of college, you got a job, or you out of your trade school, or whatever it is you're doing professionally, you're now doing. So start at 25. At 45, this is what you would have. How many people at 45 have that sitting there? And that's just one element and component of your investment strategy. This isn't the totality of it. This isn't a one-stop shop. This is a good foundational move. And it's $292. Now, say, for instance, if I just simply said, okay, I'm going to take the money I do have now, and I'm going to put half of it in there. And I'm just coming up with numbers out of nowhere, easy numbers. So I'm going to say 5,000 as an initial investment and 1,000. Now, obviously, if you don't have this much, I'm going to go to lower numbers to show that. But so at 1,000, same number of years, 20, same number, same interest rate. And you put that in, and all of a sudden you're 606,000 at age 45. By doing that, 606,000. What you're doing is you're compounding not only what you're investing, but you're also compounding on the compounded growth. So the interest payment on what you're investing is also compounded. So say, for instance, if you earn $1,500 in interest, then you also earn interest on the $1,500. So it's a beautiful thing. Now, here's the thing. Most people if we're honest, are dealing with compound interest, but they're dealing with compound debt, compound interest on a mortgage loan, compound interest on car loans, compound interest on a number of things. So we are compounding debt, the vast majority of people, living at our means, compounding debt instead of growing debt. But this is compound growth. This is saying I'm going to invest in something that as time passes, it pays back over and over again. And if you're leaving the money in and you're constantly adding to it, it's growing on the interest and on what you're contributing plus the balance. Just a beautiful thing. So let's look at it and say, okay, man, I ain't got no $5,000. Okay, let's go back. Say your initial investment is 500, and all you can afford to put in is $100. Now, and this may be reality for somebody, but what I'll tell you is when you really start trying to prioritize the responsibility of building wealth and growing wealth and understanding the importance of projecting it beyond yourself, you start to say, okay, do I really need to spend this year? Do I really need to spend this? And what you'll find is if you can take a couple of years where you tighten the bolts and say, I'm not doing that this year, I'm not doing this year, I'm going to put it in this, within a few years, you'll find that you are able to now do things that you were struggling or straining to do with ease, but it calls for, so a lot of people will say, I can't, But I tell you what, when you really truly start to search, you'll find that a lot of the stuff you think you can't do or you don't have, you're just spending it on things that aren't absolutely necessary. And you've got to reprioritize your discretionary spending. This is something that I tell everybody, you need to take 20% of your gross income and tax yourself. The government taxes you and you pay them, you don't say nothing. You let them take that money. Tax yourself and invest it. Tax yourself 20% of your, it should be non-negotiable. It should be set. If you got to set it up so it comes immediately out of your account and goes into another account to be invested, you need to do that because what's possible beyond that is unbelievable. So now we dropped it down to $500 and $100 a month. $500 initial investment, $100 a month over 20 years. And you still end up with $60,608. Now the question is, how many people are sitting up with $60,608 in their bank account or at their disposal? And this is, again, just a part of your overall net worth, because you over time are also going to be investing in other entities like real estate, like high performing long-term stock options and things of that nature. So it's all in businesses, and it's so many other things that you're going to be doing. But in essence, I'm just looking solely at this calculator. Now, this is just 20 years. This is just, I'm starting at 25, at 45. Now say, let's put up here, go back, put the 5,000 in and say 20 years. And you're going to put in 100 a year. There we go. But we're going to do it. I think that's not going to be 20 years. We're going to say 40 years. So 25 to 65, that's 40 years. That's where most people are talking about retirement. And you put in 5,000, you did $1,000 a month. What do you end up with? $3,678.85. Now, again, depending on your lifestyle, that'll be all you need to survive on and create trust funds. But that's not how I would do it. How I would do it is I would say that's $3,678 that I have to invest. And I can now move it and invest in other things that may grow quicker now that I'm older and I have less time to build wealth. But it started, it set the foundation, and now I can literally diversify while also still using this as a mechanism because I'm still living, it's still growing. And say, for instance, if I live 25 more years to 90, then you're looking at an unbelievable amount of wealth to leave behind it. And we're going to talk about how to use trust to do that. When you use trust to leave money behind, you're able to protect wealth after you're gone. You control the conditions and the different stipulations of how money is distributed. And you can literally dictate certain things. Like, I love how John Rockefeller passed down his wealth. Whether you're a fan of the dude or not, the way he passed down his wealth is he guaranteed that his descendants for generations would receive, because in order for his children to have gotten their wealth from him, they had to create trust funds for their children. And only half of what he left them gets to them. One half of it goes to the trust, and they have to contribute to the other half of the trust. So John Rockefeller is still contributing to half of the trust for his descendants generations down the line. It's an unbelievable thing, and it's a way to protect it. Number two, with a trust fund, you dictate distribution of funds and how they're distributed, and the trust will decide and manage that. And so it's so much harder for a descendant to run through money that you worked hard to create. Plus, it teaches them, if you're doing it right, teaches them to manage it. But you can go to any compound interest calculator and plug in, money or whatever, and do it. I'm gonna try something else. We're gonna put 5,000 in, and we're not gonna contribute anything monthly. We're just gonna put a one-time contribution over 40 years at $5,000 at the same percent. Still $130,000, a one-time contribution of $5,000 over 40 years. So say for instance, you start at 25, you say, man, I'm gonna take this stipend or whatever I got, and I'm gonna just put it in here and I'm gonna leave it. 130,066. And here's the problem. Guess what's happening when you're not doing this? You're spending money probably beyond your means, probably got all these credit cards, and what you're doing is doing the opposite. You're putting yourself in compounded debt, and it's growing and it's growing and it's growing and it's growing. Now, for the age group over 50, and here's where it gets interesting, and I always get encouraged. I found out when with Warren Buffett that 90+% of his wealth, and I think he's worth close to 90 billion right now, was generated after age 50. So people are saying, what about when you're 50? Well, obviously, if you're 50 and you have a number. So here's the thing. One of the things that you have to do, the first thing you have to do if you are over 50 is you're going to have to come up with a number. You're going to, okay, you know what you're doing now. If you're working, if you're retired or whatever you're doing, you know what you have coming in. You need to know how you want to live, what that looks like, and what it's going to cost you annually. And then you need to predict on average how long you're going to live. I think that everybody needs to project to 90. And the reason I'm saying that is you got a bunch of baby boomers who are outliving their retirement funds, their nest eggs, because the lifespan for almost everybody except black men is actually increasing. So you end up outliving it. So I say go to 90. But what you're going to do is then after you have determined, okay, this is the lifestyle I want to live. I'm going to take this many trips a year. I'm going to do this. House is paid for, or I want to have the house paid off by this time. So you need to have an understanding of exactly what the cost is to have all of that done. And you will have to be a little bit more aggressive in what you're contributing. It means probably a little bit more sacrifices on what you're doing now. If the ultimate goal is to say, by the time I start reaching time where I know it's going to be harder for me to work, or if you're one of those people who have forced retirement, fortunately, I own my own company, so I'm never going to retire. Now I'm starting to structure my company so that it's easier to pass down. It's not so much me that makes it valuable, but what I've created within it. Because a lot of that one-on-one stuff is me. And so I could pass it down, but if I'm not there, it's pretty much worthless. And it's increasing the value of the company also, because now the company has value outside of me. Now I'm the force behind it, but this is what you have to do in increasing your net worth, but it's also what you need to do when you're starting to think about what you're going to leave behind. So what I would say is you're going to have to play with the interest calculator based on what that number is. Okay, what will it take me to live to 90 if I retired at this age, whatever that age is? And then you will say, okay, how can I generate that by this age that I plan on retiring? And what other mechanisms can I use to create passive income? One of the reasons why I always push the passive income thing with my 7-day online business launch course is because the internet isn't going anywhere. Social media isn't going anywhere. And all of the new instruments that are having, that's why it's going to be imperative to learn how to manage and use AI to optimize how you move in business, how you move in fun, in investing and managing your money. It's AI is going to really simplify that for you. And those are the things that like I said, I'm talking about that in the webinar on Friday. So if you want to attend that link is in the description box. But passive income that you can create, especially passive income that is heavily automated. That's that's what passive income means, is that you do it and then it keeps coming in. Probably something like a rental property where you invest in it once. Obviously, you have to maintain it, make sure it remains livable and stuff like that. But for the most part, people move in and they pay you. And it also goes as a part of your net worth, which you can leverage when the need comes. to make financial moves. Most people with high net worths spend a lot less than you think to move into position to take and move deals. They leverage their net worth with promissory notes. But anyway, so the thing is, you just simply have to be, when it comes to compound growth, it's a long-term investment. So when you start talking about over 50, you have to become a little bit more aggressive. You have to make some more sacrifices. But the way that I have decided to do it is, instead of sitting up and saying, I'm going to make more sacrifices and I'm going to not do this, not do this, which I don't do. I've lived. So I've had all the things that people talk about doing. I've done all that. So I'm really truly streamlining because I'm growing my company. But if I'm talking about doing it after 50, here's my advice. My advice would be create more income so you have more money to invest. So multiple streams of income now. And also afterwards. In my philosophy on retirement, number one is, I'm not going to retire because I see retirement in my field. I study it a lot, where mental and cognitive decline starts when you stop having a meaning and a reason for getting up and doing something. Now, the goal is to not have to work by a certain time, but you should want to have something that drives you to get up and do something you get excited about. Because what I find, when people start sitting still and they start losing meaning for what they're doing every day, it starts to create a cognitive decline, depression, and a bunch of other stuff sets in, and quality of life declines. So, that's why, and another reason why I admire Warren Buffett, because you look at him, he's 90 years old and he's still excited to talk about it. And so that is how I would do it. I would look at ways and mechanisms to create passive streams of income that are in addition to the income I'm already earning. But instead of spending it on stuff and, lavishing myself, I would take it and invest it in stocks that are available. And what I'm saying is, no matter how old you are, if you have your wits about you, there's an opportunity to get out there and make money, and take that money and invest it. Take that 20% minimum should be taken from any income stream you have and put into an interest-bearing account or a high-performing stock that has proven over the long term that it's going to perform. Here's something that's a little off, but anytime I talk about the stock market at all, I always try to throw this disclaimer in. Stocks are going to fluctuate. Ray Dalio, another person that I drew from, has gone on record and said that the stock market is the only place where, when things go on sale, people panic. What is he saying? He's saying that when stocks drop, people panic and sell. Well, that's when crisis investors buy. Why? Because they understand that the company will rebound. They've done their research and they know that the market is going to shift. You're going to have bear markets. You're going to have bull markets. You're going to have crashes. It's going to happen. But the market always recovers, always. The Great Depression didn't start destroy the market. The last major recession didn't destroy the market. It recovers. So you look at companies that are able to sustain in those downtimes, and you hold. You hold because the value returns. You only lose in the stock market when you finalize the sale of your stock. So if I buy a stock at 100 and it drops to 50, I haven't lost 50 until I sell it. My stock has lost value, but if I hold it, it may return to 100 or even greater. And a lot of times when the stock market goes on a decline, the longer it's on the decline, the stronger it rebounds. And a lot of times it rebounds so strongly that the stock is stronger than it was and more valuable than it was before the decline. So those are some things that you need to stay encouraged on. Again, if you want to work with me, there's an opportunity in the description box to upgrade free to my platinum package. Also, this is the last day to register for the Unleashing the Power of AI on Friday. So I'm about to get off because I'm about a minute from being late to my client, but email me if you got questions. That you should have the email somewhere on there. On that note, look, I'm about to get out of here. Thank you guys for allowing me to have your time. You have an unbelievable day. As I always say, I live my life on full so that when I leave this place, I die on E. On that note, I'm out of here.